Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with Sam Stovall, Chief Investment Strategist at CFRA Research. Welcome to the podcast, Sam.
Hey, happy to be here, Mike.
Now, Sam, I'm an avid reader of your publication, The Outlook. I think you at CFRA, you guys do great work there. And in that last weekly update, you talked about September's slippery slope. And I was wondering what the advice for investors was there, why you use that name, and what kind of rough sledding people might be looking out for in the next couple of weeks.
Well, I like to advise investors, especially those that have long-term time horizons, et cetera. Don't let your emotions become your portfolio's worst enemy. And the way that could happen is we start to see an increase in volatility. We start to see downward movements in the markets for the month of August and September. And October, in terms of volatility, is the worst of the year, with 35% more volatility than the average for the 11 months of the year. So I just basically wanted investors to know that we've started a digestion of recent gains at the beginning of August. Maybe it's run its course because we're above the 50-day moving average on the S&P 500 right now, but who knows? There still could be more downside, but don't let that take you off your long-term path.
Got it. Okay. I know that your firm and you are a big proponent of sector-based investing, trying to find groups that can outperform even in tough markets and avoiding those that underperform in good ones. So I'm kind of looking at your sector outlook right now. I mean, what does your work suggest is particularly promising for investors, and where are some areas people might want to stay away from for a while?
Well, when the market declines, not surprisingly, investors gravitate toward the defensive areas of the market, meaning typically food, beverage, tobacco, healthcare, even utilities, and slightly real estate as well. But those times can change depending on what is driving the market. A threat of higher interest rates actually does not do utilities any good because utilities are a bond substitute. Ditto for real estate. And we've also had our fair share of problems recently with consumer staples. So what we're advising investors is, yes, this is likely a short-term digestion of gains, but because investors are going to be looking to 2024, expecting a more than 12% jump in earnings, prices lead fundamentals, and that's why we had a very strong beginning of the year through July 31. We're taking a bit of a pause, but I would not be surprised if consumer discretionary, communication services, and technology take a leadership role toward the end of this year and into next.
Got it. And that actually led to the next question I was going to ask anyway, is whether you anticipate, is this largely just a seasonal thing, this period, August, September, that's tough? You anticipate that's going to change and the script is going to be flipped a little bit as we head into year end?
Yes, I mean, that is our forecast. Obviously, it's not a guarantee, but our belief is, seasonally, there's that old saying of sell in May and go away. I always like to tell investors you are better off rotating than you are retreating, meaning stick with stocks, just gravitate toward those that have lower volatility, less beta than the overall market. But remember that the market does tend to outperform in the 6 months from November through April than the 6 months from May through October. Usually there is a holiday pop rather than a drop. And as a result, just let yourself know that we could be seeing good times again come the latter part of October toward the end of the year.
Okay. And I think an obvious thing to touch on here, too, is kind of the influence of the presidential election cycle on markets. I mean, you had a recent Yahoo Finance interview where you talked a little bit about that. I was wondering if you could expand on that. I mean, what does your work suggest we're facing as we roll into next year's presidential election?
Sure. Well, the third year, the pre-election year, historically is by far the best year of the four-year presidential cycle, gaining nearly 16% and rising in price almost 90% of the time. Election years aren't too bad either, especially for a first-term president who is up for re-election. Depending on which one you regard as Harry Truman's first year in office. You could say that only one of 11 times the market was down, or none of 11 times was the market down in that election year of a first-term president. So that offers an awful lot of optimism for investors that this baby bull market still has further to run.
What about the earnings outlook? You did briefly touch on that earlier. I mean, on Twitter a few days ago, I think you pointed out the EPS for the S&P 500 was down about 6% overall. I know some of that's energy holding that back and so on, but that was actually better than analysts were looking for. So, as we wrap up that Q2 season and look forward to 3 and 4, what are you seeing on the earnings front?
Well, not a surprise, but management has learned how to manage expectations. At the end of June, it was forecast that the S&P 500 would show an 8.3% year-on-year decline for the second quarter. Now that estimate is for 5.5% shortfall. And instead of getting a near 2% decline in the third quarter, now it's 0.5%, and a more than 8% rise in the fourth quarter, leading to a full year gain next year of 12% plus. So prices lead fundamentals, and I think that's why investors are holding firm. We just went through a decline that couldn't even be called a pullback because we did not eclipse that minus 5% give back. And I think one reason is because investors don't want to get out of the market ahead of an earnings improvement.
And do you think that the earnings improvement that we're likely to see again as we get to the back end of 2023 and rolling into next year, it sounds like you think that's pretty sustainable. And I'm just curious, what do you think is going to be driving that again as we head into next year?
Well, we do think it's fairly sustainable. 9 of the 11 sectors posted earnings improvements in this second quarter. And as we move forward into the second half of 2023 from an earnings reporting perspective and into 24, an even greater percentage of these sectors are expected to show growth. So I think what's driving it is that employment trends remain fairly sturdy. The Fed has been doing a very aggressive job of trying to corral inflation. Certainly we'll get the PCE report on Thursday to see whether they are doing as good a job as they need to. Our belief is that they probably will have to keep rates higher for longer, because we believe it'll take longer for the year-on-year core PCE to approach the Fed's goal of 2%. Likely the fourth quarter of 2024 will be when that'll happen. But I think investors feel optimistic that at least if the Fed has finished raising rates, then that could be reason to celebrate.
And that's great that you brought up the rate outlook. I mean, we all just saw what Fed Chair Powell had to say at Jackson Hole. I looked at before our interview, I think this morning, the CME chance of a rate hike was about 21% at the September meeting is what we were pricing in. That's small, but still there in terms of some pricing in of a possible rate hike. What do you see happening, again, in the meetings that we have between now and the end of 2023 for the Fed?
Well, we don't see a rate hike in September, so we're in the majority based on that CME tool. And for November, there's a possibility that the Fed will decide to just have one more hike before they call it quits. But of course, there's going to be an awful lot of data between today and the November FOMC meeting, so there could be a lot of data that will dissuade the Fed from raising rates. So we'll just have to take a wait and see attitude. History then shows us that the Fed typically starts to cut interest rates an average of 9 months after the last rate hike, and that the S&P has gained an average of 13% in that time frame, accompanied by gains for all sizes, styles, sectors, and nearly all sub-industries within the 1500.
Well, when you look at the inflation and some of the progress on the jobs front, I mean, the Fed's never going to come out and say we want to see unemployment go up or less people have jobs, but I think that they probably, things like the JOLTS report that just came out that kind of showed at least the job market coming off the boil a little bit. That has to be encouraging, right, from again, a policy standpoint.
Absolutely. With the JOLTS report coming in weaker than the month before, that gives hope for the ADP report, as well as the Friday non-farm payrolls report for July. And expectations are that at 160,000, maybe that number will be reached and therefore not exceeded. The unemployment rate will stay at about 3.5%. And that the hourly earnings will likely decline. That actually could be a good thing and give additional reason for investors to feel optimistic that the Fed is very close, if not already done, with their rate tightening cycle.
When you look at your overall, I would describe it, I guess, as kind of a relatively optimistic base case, longer term, especially once we get through this shorter term period of turmoil. Is there anything that sort of in the back of your mind you worry about most, or anything that can kind of upset the apple cart amongst the things you see out there?
Oh, sure. Well, I'm a big believer that history is a great guide, though it's never gospel. But a lot of history does say that we are due for a recession, or at least that the market has been pricing one in. What we don't know is when will it actually occur. I mean, traditionally, whenever the year-on-year rise in headline CPI exceeded 6.5%, it preceded a recession. Whenever we had leading economic indicators down year on year, that preceded a recession. An earnings recession, which we are in the midst of right now, meaning more than 2 quarters of S&P 500 earnings declines, that too has typically led to recession, not to mention inverted yield curves across the yield curve spectrum. So those factors would imply that, gee, maybe we should have a recession. Maybe it'll simply be a very soft landing or a very delayed but mild recession.
And I guess on the flip side, I mean, try and wrap things up. You're close to wrapping things up on an optimistic note. What do you think could go the most right? Are there particular sectors, developments you're looking at that you think could really lead to an even better market than you're expecting?
Well, you're bringing up a good point. I like to say that when life gives me lemons, I try to make whiskey sours. And I think that history basically told me to get the shaker ready early in the year because we had a down year followed by an up January barometer and a first quarter low that did not exceed the prior December low. Those factors together have never preceded a full year decline, and actually the S&P gained an average of about 25%. So history basically said we're going to have a good year and it could be a whopper. And if we look to the second year of a bull market, it tends to be good. Maybe not great, but certainly good, and more reason to be optimistic and to expect a continued ascent in the market indicators.
Got it. Got it. Well, Sam, I know you're going to be speaking at our Orlando Money Show Traders Expo at the end of October. It's still about 2 months away, but I was wondering, any sneak peek at what you could tell the viewers you think you might be talking about, or some of the points you might be touching upon?
Sure. Well, I wrote a book a few years back that nobody bought. Just kidding. But what I do is I talk about using investing rules so you can extract your emotions from the equation. I'm going to be talking about correlation, or how by simply combining the poster child sector for growth, technology, with consumer staples, you end up with a return that exceeded tech since 1990 with 40% less volatility. I'll also show that momentum can be a very good way of outperforming the market. Let your winners ride, but cut your losers short. And I will share with you what number of month look back tends to be optimal. And then lastly, I will talk about seasonality, talk about my ETF, the ticker SZNE, and how it doesn't work all the time. But if you are a nervous Nelly and we're thinking about selling in May, like I said, you're better off rotating and sticking with stocks than you are bailing out altogether.
Great. Sam, well, again, thank you so much for your insights. Appreciate you taking some time out here, and thank you everyone for watching. If you do want to hear more from Sam and dozens of other market and economic experts, you do want to join us at the Money Show Traders Expo Orlando. It runs from October 29th to the 31st at the Omni Orlando Resort at Champions Gate. If you're a fan of golf, you're going to have the opportunity for plenty of that. And let's be honest, Florida weather is a lot better in October than it is in August. So I hope you're able to come out. Sam, again, thank you so much. And if you're watching, do hit the like or subscribe button if you'd like to get more content from Money Show.